Good day, fellow investors. Dollar General stock looks like a strong relative buy at the moment. We've discussed Dollar General more than a year ago. The stock price was 120. And in that video, I said that this was a period of exuberance on the pandemic overspending and that the stock needs to go below the long-term trend in order to make it a buy. Now, there were a lot of comments. Thank you for your comments. And from 120 to 75, yes, that is very much below the long-term trend. And Seth Klarman, the great value investor, has also started a position in Dollar General for the likely long-term cash flows that we will discuss. And this is, let's say, the growth trend of the retail environment of the company itself. And yes, this was clear exuberance, and now we are below the trend. And likely, if it just reverts to normal, that's 100% return. For those who don't know me, I'm a value investor, I'm also a book author, and I thank you all for the great ratings on the book on Amazon. Let's start with Dollar General business analysis. Immediately go to the last results that are still from August, but if I look at these numbers, everything is okay. Okay, same store sales, flattish, but an increase is always an increase. Operating profits, as they are doing the promotions, a little bit more increased competition, a little bit less spending. Okay, nothing crazy. Diluted earnings a little bit down. Still very strong. Cash flows 1.7 billion, and they are also paying a dividend. They are not satisfied with what's going on, but they will work to improve it. And this is retail investing. Gross margins go from 31, 32 to just a little bit above 30, so nothing, but that has a huge repercussions on net income margins from 7% to 4%, and immediately everything looks different. Net income goes from 2.7 billion to 1.6 billion, and that is a huge difference, half of it. And that's also reflected then in the stock price. If I look at the numbers, the company is still growing. If we look at the revenues, growth, gross margins, you can see stable, then the pandemic boom, and now we are a little bit down for the last 12 months, below 30%, and that has an extremely significant impact on net income. But the dividend is still there. They will likely keep on paying that, keep on growing. This is something common for Wall Street. When the stock price is high and there is exuberance, they are repurchasing common stocks, throwing money away. And when the stock is cheap, they are not repurchasing. Okay, that's common Wall Street fault, but what can I do about it? However, the softer sales there represent an opportunity. But let me show you what Wall Street is thinking about Dollar General. When the stock price was high, it was a buy. When the stock price is down, you better sell. So we have this dip in estimates, and then they are estimating for a return to, let's say, growth, but it's not like a disaster. Let's say even stability, and this is what I think that Seth Klarman bought into, stability. Look at ratings. When you see most of Wall Street telling you it's a hold on Wall Street is a sell. That's how they do it. They now all lowered their target projections, but they just lower them after the stock price goes down. So when the stock price was 250, their target was 270. Now the stock price is below 100 and they have not yet adjusted, but you can see how Wall Street always adjusts to the stock price. When the stock price was extremely high, exuberant, everyone was considering it a buy. Now most of Wall Street tells you it's a sell. We value investors usually do the opposite of what Wall Street says. It works over time. Let's go to the last conference call. I always look to see what are the analysts worried about and also to see about the business, the environment, the economy. And this is very interesting how the weaker weeks were when customers had to wait for the paycheck. So it's getting difficult to get to the end of the month for Dollar General customers. But the key question is, the market is saying the Dollar General and small box value model is simply structurally challenged or broken. So a year and a half ago, everything was great, great growth, great everything. 1 year of stagnation compared to the great numbers in the past, and now immediately it's structurally broken for Wall Street. The answer is that there are challenges, but not on the model because everything is working, new stores are still profitable, and it's just a transition period and a transformation. And it's never usually a straight line to the top. Very good answers by the CEO. Over the long term, the drivers are there, higher returns opportunities are there, and also cash from operations was up 127%. There will be great news to watch. This will lead to a volatility in the stock price. If the news is good, stock will go up. If the news is bad, the stock might continue on the downtrend as people are selling. But let's discuss now investing in Dollar General. The risk and reward. Number of stores growing. Thus the model is not that broken, everything looks good there, the cash flows are still there, especially when you compare the cash flows to the market cap. That's now a 10% yield. Plus the growth, that's more than 10%. This is when Seth Klarman goes in. Cash from operations, very good, a little bit up and down, but that also includes inventories. Sales are up, nothing wrong. When I look at the numbers, it looks like the model isn't broken because a broken model doesn't do 3 billion in cash flows a year. The trend will likely continue. There will be ups and downs, exuberance, panic. Buying this and then catching the trend up, I think this is a 2x over the next 3, 4, 5 years. Let's put it into our value investing quadrant. Let's put it to market risk, so medium risk. Then we have a 10, 11, 12% return here, which puts it into the buy side of our risk and reward value investment quadrant. It's certainly better than what the market is, even if I would put the S&P 500 somewhere here, but it gives a 10% cash flow return yield. Perhaps a recession will even put more customers there, so there is something very interesting with DG. I will keep watching it, might also check the earnings when they come out soon, and then we can do an update. Don't forget to check the value investing quadrant video where you have all the links to the stocks that we discussed, and you can see here a trend that there is, for example, retail getting a little bit cheaper. Check everything here. Thanks for watching. I'll see you in the next video.